Republicans in Congress have proposed a menu of potential cuts to trim federal funding. However, several potential spending cuts will affect college affordability, from student loan repayment to financial aid programs. Overall, the savings from these spending cuts are relatively low as compared with other options, such as establishing a 10% tariff, cuts to Medicare and Medicaid, and eliminating the home mortgage interest deduction, which could save trillions of dollars. These spending cuts would save only around $40 billion a year, with 1/3 of the savings coming from the repeal of the SAVE repayment plan. So what's on the table? Let's break it down. First off, can Republicans make massive changes? Passage of Republican priorities, including an extension of the Tax Cuts and Jobs Act of 2017, may require a repeal of several forms of federal student aid. Even though Republicans control the 119th Congress, they do not have a 60-vote supermajority in the U.S. Senate, and they have a narrow margin in the U.S. House of Representatives. If legislation does not have bipartisan support, Democrats can filibuster most legislation in the Senate. The main exception is a budget reconciliation bill, which requires just a simple majority. But budget reconciliation bills must cut the budget deficit through either revenue increases or spending cuts, or a combination. Any increase in spending must be offset through savings elsewhere. The Tax Cuts and Jobs Act of 2017, for example, was passed in this manner. Assuming they do not get the votes needed, here's what some of the potential changes are. Several education tax breaks may be repealed to offset an increase in costs. The American Opportunity Tax Credit, or AOTC, provides a partially refundable tax credit worth up to $2,500 per year per student for up to 4 years based on amounts spent on tuition, textbooks, supplies, and equipment. Repealing it would save about $5.9 billion per year. The Lifetime Learning Tax Credit, or LLTC, provides a non-refundable tax credit worth up to $2,000 per year per taxpayer based on the amount spent on tuition, textbooks, supplies, and equipment. Repealing it would save $2.6 billion per year. The exclusion from income for qualified scholarships and fellowships provides tax-free status for scholarships and fellowships that are used to pay for tuition, textbooks, supplies, and equipment. Repealing that would increase revenue by $5.4 billion per year. The student loan interest deduction is an above-the-line exclusion from income for up to $2,500 in interest paid on federal and private student loans. Repealing that would save about $3 billion per year. There is a proposal to increase the tax on net investment income for college endowments. Currently, 58 colleges that enroll at least 500 students have endowments of at least $500,000 per student. These colleges pay a tax of 1.4% on their endowments net investment income, yielding $244 million per year. Increasing the tax rate from 1.4% to 14% would increase revenue by about $2.2 billion per year. A proposal to incentivize colleges to spend more of their endowments on students would increase the number of colleges subject to the endowment tax by 10 to 12 colleges. This would increase revenue by $27.5 million per year. Now let's discuss some student loan changes. In addition to repealing the student loan interest deduction, several proposals would make cost-saving changes to federal student loan programs. First up, repeal the SAVE repayment plan and streamline income-driven repayment plans. All current repayment plans would be replaced with just 2 repayment plans for new loans made on or after July 1st, 2024. That's a standard repayment plan and a new income-driven repayment plan. This would save about $12.7 billion per year. Next, eliminate Grad Plus and Parent Plus loans for new borrowers as of July 1st, 2025, and New Plus loans for all borrowers by 2028. Establish new and annual aggregate loan limits for federal loans. This will save about $1.9 billion per year. Next, eliminate subsidized federal direct Stafford loans so that all new federal education loans will be unsubsidized. This will save about $1.5 billion per year. Next up, create risk sharing for federal student loans and create the Promise Grants program. Colleges will be required to make annual risk-sharing payments based on their students' repayment activity. This would fund the Promoting Real Opportunities to Maximize Investments and Savings in Education Promise grant, which would improve the college affordability and college success of students. Risk-sharing net of the Promise grants will save about $1.8 billion per year. Next, repeal some of the regulatory changes made to the closed school discharge, such as the automated process for discharging loans made to to borrowers who attended schools that closed. This will save about $490 million per year. Next, repeal some of the regulatory changes made to the borrower defense to repayment discharge, such as the changes that made it easier for borrowers to discharge their loans due to a college's misconduct. This will save about $970 million per year. And last, limit the regulatory authority of the U.S. Department of Education to create new regulations that increase the cost of federal student loans or that would have economically significant effects. This would save about $3 billion per year. It's impossible to know for certain which, if any, of these changes may pass through to final bills and eventually get approved. However, any of these alone could make higher education more expensive for students and their families. At The College Investor, we'll do our best to keep you informed on the student loan and college planning process. Be sure to like, subscribe, and comment below so we can keep this important conversation going. What do you think about these proposed cuts to federal student aid? How could this impact your college planning in the process? Please let us know in the comments below. This is Andy from The College Investor. We'll see you in the next video.